everybody. It is Thursday, September 14th, and we just wanted to send out a weekly update, fill you in on some things that we're talking about this week, some things that we're seeing. I am Mike Preston at New Harbor Financial, and we have a lot of conversations with a lot of people, not just existing clients, but a lot of people who watch us on YouTube or watch the Wealthy On channel in particular. They reach out to us and they just want to chat, and they value the fact that they've got somebody to talk to that sees things a little bit differently, or that at least looks at things with a skeptical eye like we do. We think that central banks and the money printing that's happened since 2009 have completely distorted asset prices. In fact, by some estimates, there's over $50 trillion that has been basically created in excess wealth because of the Federal Reserve bringing their balance sheet from under $1 trillion in 2008 to essentially $10 trillion. It's a little bit below $9 trillion now, but about a year ago, it peaked out at $10 trillion. And what happens is that money, or the assets that are purchased by the Fed, they go onto the balance sheet, but the money that they use to purchase those assets go into member banks, and then from there it filters into other banks and into the system through fractional reserve lending. So the addition of nearly $10 trillion through the fractional reserve lending system multiplies several fold from there. So we have massive liquidity, particularly since 2009. And it's all been because the Fed has wanted to focus on the wealth effect. If you've got a big pile of debt, that's going to be difficult to service going forward. And you need to keep the economy going so that people have jobs and they're making money and they could buy things to keep the system lubricated. The Federal Reserve has engaged on what's called quantitative easing for a long, long time now, almost 15 years. And really every other central bank in the world followed suit. So this has caused stock markets to hit insane levels. The stock market is trading above the highest levels in recorded history. If you use statistical measures that we think are valid, like the Shiller PE ratio or the margin adjusted Shiller PE ratio, or even if you look at the stock market capitalization divided by gross domestic product, that too is at nosebleed levels. So the real question is this going to be sustainable? Is this a permanent high plateau? Is it different this time? I can say for sure that it has been different this time for longer than it's ever been different this time before in recorded history. So the big question is, and we talk about this with almost everybody, is can the Fed get away with this forever? Well, they've gotten away with it for a long time. We still trust math and valuations. Therefore, we're very conservative. We think the market is still in the early stages of a bear market that likely started back in January of 2022. But here, as we sit today in September, halfway through September, markets are not too far from their highs. Volatility is back near all-time lows. I just noticed that today the volatility index, the VIX, closed in 12.8 or something like that, under 13 again. So there's no worry around. The stock market seems to have reached a permanently high plateau. We don't believe it's going to stay there. So therefore, we're very defensive. We have actually made some changes in the recent weeks to basically change a couple things in the portfolio. Nothing major, but we did have some short hedges on our books in the form of non-leveraged inverse ETFs. We actually removed the non-leveraged inverse ETFs that we had on as hedges, and we replaced it with an at-the-money option that goes out to the third Friday in December. The reason we did that is because we were seeing on the weekly chart of the S&P what looked to be a basing pattern, a cup and handle, basically. And I'm looking at the chart now. Here is the weekly chart of the S&P 500. So this goes back a couple of years. The market topped out January 4th of 2022 and had a relatively contained decline throughout the years, down in the 20-something% range. It bottomed in October. We actually added a small tactical long at this place, but down here in October, we were looking for 35.70 to be touched, and it was. What we didn't expect was a straight up 45-degree bounce all the way until today. So if you take a look at this chart, it's had this big consolidation pattern. I still think that this is a counter trend bear market rally that's going to resolve to the downside. In fact, I would expect 4,200 to be seen pretty quickly once this breaks to the downside, and then that would open up potential for much lower prices. But what we can't deny is the fact that this consolidation has taken place. It looks like a cup which is now a handle on the right side these last couple of weeks. A month or so ago, there was 3 big down weeks. It looked like we were resolving to the downside, but here we are a month into a recovery. Meanwhile, our shorter term indicators in terms of market breadth, which is essentially the number of participants in the market that are leading the charge, has started to improve ever so slightly. Most of that improvement is concentrated in the NASDAQ. So it's still fairly narrow, but some of those indicators are starting to firm up. And what we fear here, quite frankly, is we get one more big week to the upside. If that happens and we clear the top of this handle, then I think that this market will likely make a run for the highs. And it's even possible that we could have another blow off top. There's some out there that think, well, we can have another blow off top. This isn't done yet. Well, we can never say never. I don't think that's going to happen. But because of the possibility of that in the shorter term improvement in our indicators, we did close our non-leveraged shorts and we added an at the money put. That gives us essentially the same hedge to the downside, but what we can do with the put is that we can predefine the risk so that if we get a blow off top to the upside here, the loss related to the hedge is very, very defined. In other words, it's not open-ended. So that's why we did that. And so just wanted to let you know about that and just talk about some other things that we're seeing this week. I might bring up a chart or two a little bit later, but this week I wanted to hone in on one thing. We've had a few conversations with people, and there's a lot of worry out there. This whole wealth effect hasn't affected everybody equally. The 50 or 60 trillion dollars of excess wealth that's been created in the last 15 years has gone mostly to less than 5% of the people, and most of that to the top 1%. So that's great if you're in that group, but it's not so great if you're not in that group, particularly if you're looking to buy a house or dealing with the inflation on a single income, trying to support a family. It's difficult, and in our view, this is likely to create some socioeconomic problems in the years ahead. So we talk to a lot of people, and they have this psychological angst about this. It seems like we have been forced, really didn't have much of a say in it, forced to abide by these rules because we live here, and notice all around us the wealth effect that maybe we are participating in, maybe we're not. It doesn't seem fair. Some people are a little bit uncomfortable with this whole idea, and as they look forward to retirement and what they're going to do with the rest of their life, we have a lot of conversations that are not your typical conversations. And so we wanted to share one of those ideas with you this week. So a number of conversations have been with people that are either in retirement or approaching retirement, particularly if they don't feel like they've got enough saved, and particularly if they have an adventurous mindset, they may want to consider exploring opportunities abroad. So a number of our clients and prospects that we've talked to, people that just want to talk to us and may or may not end up being clients, have explored the world. At least 2 or 3 instances. I've talked to people that have places in Turkey, a number in Portugal, a handful of our clients in Mexico, Costa Rica, Colombia, Ecuador, etc. So a number of these countries, particularly Mexico and South America, you can live on roughly 1/3 of what it costs to live in the United States. So all of the assets in the US, essentially all of the assets, are completely overvalued. And so some people are saying, what can I do? Well, consider if you're an adventurous person, consider other things like travel to Central America, South America. If you don't know Spanish, it's a great opportunity to learn it. There's other opportunities that some of our other clients have explored. A number of people have said good things about the Philippines. A couple of our clients have tried Thailand. I know it's not for everybody, but I can tell you there's dozens and dozens and dozens of people that we've talked to that have done this and they've really liked it. And in fact, you can live in some of these places like Colombia, for instance, or the Philippines on less than your average Social Security paycheck. So even if you feel like you've messed everything up in your life in terms of savings, I would say don't fret. There's alternatives. And there's a lot of things to, to think about. And it's hard to just up and move to another country without knowing somebody there. So it helps to either know somebody there, have friends that have already done it, or plug into an expat community on the internet. Expat means expatriate. So this is a big thing. I mean, the average Social Security check is somewhere around $2,500, $3,000, something like that. You can live in most of these places. A couple can live in most of these places for under $2,000 a year. I mentioned the language barrier is often the big ones, but a lot of people know these other languages, or if you don't, you can pick up quite a bit of it in just a few years' time. So when we talk about these things, invariably the discussion goes to the U.S. dollar. And so let's just share some of our thoughts on the dollar. I want to share a long-term chart on the dollar as well. This is a monthly chart of the U.S. dollar. Actually, this is a weekly chart. Let's start there. A weekly chart of the U.S. dollar. So the dollar peaked out about a year ago at 115. This is a basket, the dollar index basket, which is heavily weighted, over 50% the euro. And then there's a big chunk in the yen and some of the other currencies. But it gives you a good idea of what the dollar has done. Let me move out to a monthly chart. Give me 1 second here. On the monthly chart, this is what it looks like over 20 years' time. The dollar has traded roughly in the 100 to 115 level here for a couple of years. The decade prior, it's been trading right around 100. So just in the last year or two, we've been seeing some strengthening in the dollar. And so we're often asked if people should move out of the dollar into whatever foreign currency they may choose, or protect, or if they're thinking about moving to Mexico, they might want to move into the Mexican peso, that type of thing. And I've got to say that we think the dollar will actually get stronger in the near term. It probably shouldn't be that way, but that's kind of how it is, because of the fact that the US dollar is the world's reserve currency, and that there's tens of trillions of dollars in the euro dollar system. Those are dollars that are outside of the United States that stay in those other countries, invariably get invested in other assets, securities, and then those securities are used as collateral to clear transactions around the world. There's no real easy way out of that system overnight. Even the BRICS meeting in Johannesburg on August 24th, where the members of the BRICS group decided that they want to potentially create another trading unit that's outside of the US dollar. They may do that, but it's going to take years, and it's not going to be something that happens overnight. In fact, it's more likely to be a long-term negative for the dollar. So shorter term, that is between now and maybe 2 years from now, I would expect the dollar to get stronger, maybe even take out this recent high at 115 and go as high as even 120 or 130, particularly if there's an economic crisis worldwide. I would expect the dollar to get stronger first, but long term, over the next 10 years, I think the dollar will actually weaken quite a bit and could even go below these previous lows in the 80s. So oftentimes people think, or they ask, should I move out of the dollar now? Should I buy property in a foreign country now? The answer is probably not. You may want to wait for your opportunity. I do think the dollar is going to get stronger. Certainly the property bubble or increased prices affected properties around the world. So I do think you're going to get better opportunities abroad and better opportunities in the United States if you're patient over the next couple of years. If you decide to have a place outside the United States, whether that's a place to live permanently or whether it's a kind of a place to go to if you feel like you need to get out of either out of the system, or you want to get out of this country for any certain reason, there's a lot of different things to think about. We can't profess to be an expert in all of them. You're going to have to consider whether to sell your house in the United States or rent it out. Taxes are a consideration in some places. If you stay for more than 180 days, you may be considered a tax resident. You could be facing taxes on worldwide income. That means income that you receive in the United States. you'd really have to look at the individual situation, do some research on the internet. There's a lot of good resources out there and expat forums that you can plug into. In terms of precious metals that we think are very important to hold on to, 5 to 10% of your investable assets, you may want to consider vaulting them in the United States or in another country, or depending upon your target country, you may want to hold some of them there with you. A few other things to think about are an estate plan, so that you should always have an estate plan, whether you live abroad or not, but that can take care of your assets, both US assets and assets outside the country. And I guess the last one would be healthcare concerns. I'm going to stop sharing the screen, but the last one would be maybe healthcare concerns. One thing we've noticed is that once clients get up into their late 70s or 80s and start having some health concerns, they often move back here to the United States. So it's, even if you were to consider doing this for your retirement, and I suggest to some people that they really should think about it, it takes a lot of the stress off of having to feel like you need a huge amount of money to produce income. You may want to think about what your long-term or end stage plan is, for lack of a better way to put it, because there are some places that have great healthcare systems, like, for instance, Medellin, Colombia has great healthcare systems. But not every country is like that. So these are some of the things we talk about. We just want people to think outside the box. So I think that's it for this week. Just an idea to chew on, and we're happy to talk with you about this or any other things that you'd like to talk about. As a wrap up, we stay very, very conservative. We are concerned about the potential for a blow off top. We've made some adjustments to reduce risk in the hedges that we have. And we'll even try to be tactical on the long side if we do get that breakout and our short-term indicators improve. We will try to participate somewhat in that, probably again in a hedge fashion. But what we're not going to do is jump in with both feet and expect this market to have a breakout that will last. That is sustainable. So with that, I'll say thank you very much. Thanks for tuning in. And as always, thanks for watching us. And we will talk to you next week.